of the financial world. We're going to break down the actual mechanics of money so you can learn the rules and, frankly, start rigging the game back in your favor. Let's jump right in. Okay, so imagine you just had a grueling month at work. Maybe you're slaving away flipping burgers. You get an email saying you've been paid $2,000. Awesome, right? But then you check your bank account and the balance only went up by $1,456. What happened? Well, invisible forces literally snatched a chunk of your hard-earned cash before it even hit your account, and they kind of expect you to just say, "Thank you." So where exactly does that money vanish to? Well, it goes toward what we like to call the cost of civilization. Funding roads, schools, and making sure your favorite local taco truck isn't secretly invested with rats. You've got income tax taking a bite right off the top. Then there's Social Security, which is basically the government forcing you to save for your own retirement now so they can pay it back to you later. And finally, Medicare, a health insurance tax that supports older folks and those with serious health issues. To help you navigate all this, here is our roadmap for today's explainer. First, the rules of money. Second, interest, the double-edged sword. Third, inflation and economic recessions. Fourth, building wealth and value. And finally, time, the ultimate asset. Section 1, the rules of money. When you hand a cashier your money, you might picture going straight into some massive, impenetrable safe guarded by a dragon. But honestly, that's a total myth. Banks are actually just middlemen. They're matchmakers. They use this system called fractional reserve banking. What that means is when you deposit $1,000, the bank only keeps a tiny fraction of it on hand. They take the other $900 and lend it right out to someone looking to buy a jet ski. They're entirely relying on the fact that not everyone is going to ask for their cash back at the exact same time. Unless, of course, it's 2008, when the whole system pretty much crumbled because of exactly that. And going a step further, currency itself is just a massive social construct. Think about it. There is literally no biological difference in legitimacy between a dollar bill and a random stick on the ground. The only reason a dollar buys you groceries and a stick doesn't is simply because we, as a society, universally trust and agree that the dollar holds value. The government prints it, central banks regulate it so it doesn't turn into monopoly money, and we all just collectively believe in the illusion. Moving on to Section 2, interest, the double-edged sword. Simply put, interest is just money's way of charging rent to exist in someone else's hands. When you borrow, interest is the literal price tag for using someone else's cash. But here's where it gets wild, compound interest. That's when every single dollar you owe starts generating its own clones. And guess what? Those clones want rent too. And this is exactly how tiny mistakes turn into raging financial fires. Let's say you swipe your credit card for a burrito. If you miss a payment on a 20% interest card, your interest starts earning its own interest. Suddenly, your $12 burrito turns into a $50 regret. Ouch. But on the flip side, if you're the one investing and earning that compound interest, your money starts duplicating itself like a video game cheat code. It's either your absolute worst enemy or your best unpaid employee. Meanwhile, the whole time you're interacting with debt and interest, lenders are silently judging your trustworthiness through a shadowy algorithm we call a credit score. Now, this isn't about how wealthy you are at all. It's purely about trust. They're asking, is this person actually going to pay me back? This little 3-digit number dictates so much of your financial life, ranging from a walking red flag at 300 all the way up to sparkling adult credibility at 850. So how do they get that number? Your score is calculated using a few specific factors, with your payment history being the absolute biggest one. Honestly, think of your credit score kind of like a pet dog. If you ignore it, it's going to poop all over your life, handing you soul-crushing 27% interest rates. But if you take care of it, feed it, and just make your required payments on time, it might eventually be a good boy and help you buy a house.
Section 3, inflation and economic recessions.
Okay, so inflation. It's basically the slow erosion of your purchasing power. It doesn't happen overnight with a bunch of fireworks. It just means that over time, your trusty $5 bill slowly buys fewer instant noodles and less gas than it did last year. Why does this happen? Well, usually it's because there's just too much cash chasing way too few goods. If 2,000 people really want a new TV, but the store only has 1,000 of them in stock, the store's going to raise the price. That is inflation in action. It helps to think of the broader economic cycle like a giant party. Everything feels great during the boom phase, right? Everyone's dancing, the drinks are flowing, but eventually we hit the peak and the lights start to flicker. Reality sets in during the bust. Jobs vanish, and suddenly the DJ is just playing sad lo-fi beats about corporate downsizing. Technically, a recession is just 2 consecutive quarters of this economic decrease. But hold on. Eventually, we do hit a painful but absolutely necessary reset, where spending slowly returns and businesses start to rebuild.
Section 4, Building Wealth and Value.
Here's the absolute secret of the wealthy. It all comes down to creating value. Imagine a simple rock. Okay, now imagine that rock is shiny and yellow. Gold. Gold isn't inherently worth more than the regular rock. Humans just place a much higher perceived value on it. Whether it's Steve Jobs inventing the iPhone or a luxury brand like Gucci selling a handbag that you could essentially buy at Target for a fraction of the cost, people are totally willing to pay massive amounts for perceived value. Basically, if you can figure out how to provide a lot of value, you're going to earn a lot of money. But once you actually earn that money, you have to protect it from the silent thief of inflation, right? To do that, you've got to trade your money for more money. We do this using diversified investment vehicles. Stocks give you these tiny little ownership slices of a real company. Bonds are where you flip the script, acting as the bank and loaning your money out to earn interest. Funds are just big collections of these assets to spread out your risk. And real estate is, well, property you buy hoping someone else will pay to live in it forever. Now, obviously, investing comes with varying risks because markets are always going up and down. But you have to look at the alternative. The real danger in the financial game isn't the risk of a temporary market dip. The real danger is keeping your money strictly in low-risk savings accounts and just watching inflation quietly steal your future purchasing power. Investing is simply what happens when you decide your money needs to stop sitting around on the couch and start actually working for you.
And that brings us to Section 5, Time, the ultimate asset.
Look, you do not need magic, you don't need to win the lottery, and honestly, you don't even need to beat the system to eventually retire with 7 figures. You really just need to use the system. You just need to be patient, stay diversified, and let compound growth do its thing over 20 or 30 years. A little bit of money invested consistently, if given enough runway, grows into a mountain. Time is literally the absolute greatest force in wealth building. Since almost all of us start out with a lot of time, but absolutely no one gets an unlimited supply, I want to leave you with this final thought. Most people go through life trading their time directly for money. 1 hour worked, 1 paycheck earned. But the wealthy, they figure out how to leverage it. So how are you going to train your hours to work for you? Take a hard, honest look at your own financial ecosystem today and ask yourself, who is